Hello, everybody, and welcome to another podcast with Investing Education Academy. You're with us. It is the month of May, so hopefully you got all your taxes done. And if you didn't, you got the extension filed. And if you didn't, go get it done. Let's just start there. Okay, that's out the way. Now, today we're going to talk about how to increase your credit score 40 to 60 points in the next 7 months. Leon's going to tell you why we chose that topic. I'm going to do a little bit of housekeeping.
Yeah, so we chose this topic one because we actually have experience doing this ourselves. So we've actually seen the benefit of it. And two, we all know this country. I mean, really, the world runs on credit, right? Like, I mean, the reason right now we're kind of in this moment we're in right now is because of interest rates, the Fed raising or lowering interest rates, things like that. So everything generally runs on credit, right? And credit is just how likely are you to pay back a loan or not. And so it's really important to have good to moderately good credit, because if you don't, it can be hard to get car loans, house loans, personal loans, student loans, any sort of loan. And as we all know, having cash for everything is almost impossible these days, to just live straight off cash. So today we're going to talk about how to actually improve your credit score. And what that'll do is that'll help you get loans, again, house loans, car loans, personal loans, that can then better your life, your family's life, things like that. So, and also related to investments, an example is I trade on margin, which is essentially borrowing money from my brokerage to then help me leverage and buy stocks. Well, that also deals with an interest rate, right? And so that again, it comes back to interest rates. Whether your credit is good or not can depend on the rate you get, things like that. So definitely a timely topic.
Yep. And so one of the things people wonder a lot of times is, essentially what is credit? And Leon explained that part, so we're good. Then the next question is, well, what's good, what's bad? So, if you're anywhere between the ranges of like 575 and below, that's considered bad credit. What happens in the bad credit range? Bad credit range means you might be denied for a house, you may be denied for a car loan, or you have to go towards with that predatory lending space where interest rates are 50%, 60% in some cases. And essentially it's making a bad situation worse. So you absolutely want to be above really a 600, but let's 575 if you start looking things up. That's the space where they say it's poor. From there, you want to get above a 700 because now you're moving into that fair range. And what does fair mean? Fair means that essentially the credit bureau has determined that more than likely you won't pay your debts on time, but you will pay them over time. And let me explain what that means. What's the difference? If you pay your debts on time, you're probably in the very good to excellent range. That means you're above a 740.
Flip to you.
Yes. Okay. So that means you're in that range where you're 750 and above. That's very good to excellent. But when you're in that fair space, they've determined that you will pay overtime, but you will not pay on time every time. I know it's a lot. Listen to it slowly. I said it the right way. So essentially, if you don't pay it on time every time, the thought is if your credit is due, if your payment is due March the 15th or by March the 8th, most companies is by March the 8th or 15th that you have to pay before it's considered late. And so you might be the type of person that's going to pay on the 23rd or you're going to pay on the 24th, but you're going to pay. You're not going to try to duck the responsibility of paying back whomever you borrowed money from or whatever institution you borrowed money from. That's the fair space. So you're going to pay overtime, but you're not paying necessarily on time. The difficulty in that arena is this: you're normally going to start getting those interest rate hits, and the interest rate is just going to make it harder for you to pay the following month. In addition to that, when you're late, it's going to continue to push you back towards being in that poor category, which is below a 580 credit score. So you're going back to that poor category, which means the next time you need money is probably going to be hard to impossible to get it from any traditional institution.
And,
So
real quick, and also late fees when you're actually late. That's another compounding effect of something that's going to make it harder to pay it off.
yes. And so late fees are 100% true. Even with your bank accounts, you have to watch those things. But we're talking about credit today, so late fees, you want to watch that. Now, what's good? Good is anywhere from like 660 to 739, 740. That's good. Good means you have a 50-50 chance of a traditional institution accepting you and giving you more, or I say cheaper money. I didn't want to say cheaper money because it sounds confusing. So I'll explain what I mean by cheaper money. When you borrow money and you have very good to excellent credit, it normally may cost you, let's say you're borrowing $10,000. The total interest on that may be $100. And this is just for instance. This is just a record, so you can understand the difference between good and very good to excellent. So it may cost you $100 in that very good to excellent space. But you come in at good and you're thinking, okay, my credit score is a 720. I'm good. That's a good space. I can get most loans. Yes, you can get most loans. But what's happening is you're getting most loans, but you're getting it at the top of that interest rate scale. So that $10,000 for you, although you will get the loan, you'll be approved, you're looking at paying maybe back $600 in interest. And that's a big difference. So, you think, oh, well, I'm good. I'm very good. What's the big difference? It can be hundreds and thousands, tens of thousands, hundreds of thousands of dollars, depending on how much you're borrowing. Because when we move into like that house space, the difference in 2%, it can be the difference between like essentially having to buy a whole nother house during the time period where you're paying your house off. Mm-hmm. So 2% can be huge when you look at much bigger numbers. So again, good means you will more than likely get approved for the loan, but you're going to be at the higher end of the interest rate spectrum for that loan. Now, when you start getting into like very good space, you're looking at 740 to 800. And even excellent, really, like 750 might start sliding you into that excellent category. But you'll see anywhere from 750 to 800 saying very good. What is very good? Very good means yes, you're going to get approved. As long as what? Your debt to income ratio doesn't become inverted, meaning you're not borrowing so much money, they determine you don't make enough money to pay this back. So at a certain point, even if you have good credit or if you're, very good or excellent, even if you don't make enough money to support how much credit you have, at some point creditors will stop giving you loans, because if you were to use all that outstanding credit, you couldn't pay everybody back. Now, under normal circumstances, you are, quote, labeled as a person that will always pay back the money on time. But if your debt to income ratio becomes inverted, you have too much debt to pay back. It's not that you wouldn't, and it's not that you won't. You can't afford it. You literally can't afford it. So, you want to be in that very good to excellent range. Very good to excellent range means also too, when you're applying for loans for your kids' education, you can go. I mean, you're not going a traditional route where maybe you saved, then a 529 plan, or you did a Series H, HHE, or I bond. You didn't do those things, or Coverdell, ESA. You decided that you were going to take loans for college, like traditional loans. That can be very expensive when your credit is good, fair, and you're probably not going to get the loan if it's poor. Now, excellent. You walk in with excellent, we're talking about cheaper money, much cheaper money. And not only cheaper money is reduced stress. Not only reduced stress, you have increased opportunities. Not only increased opportunities, but now you can actually help other people out. So how do you get to that space? That's what we're talking about today. How to increase your credit score between 40 and 60 points. First, this is not advice that everyone should do. Please talk to your professionals at the bank before you do it. We are not giving individual advice. This is an overarching strategy that people can use in the United States. It may be in whatever country you're in, it's something similar to this, but we're not saying just go do this blindly. But we are saying this is a strategy to consider after talking to your professionals about your particular situation. All right, everybody got that? Everybody got it? Cool. We can move on. What do I do? guys, tell me, what do I do? Well, first, if the best scenario, we're giving you the best scenario for this. The best scenario is doing this inside of a credit union. So for those of you all, a traditional bank is normally a bank that's, for profit, has stockholders, and it's designed as a business. Banking, yes, is a business. A credit union is a bank, but normally it is designed for the betterment of the community. That is the reason for its existence. Whatever community it might be, it's designed for the betterment of that particular community. And normally it's not only more favorable rates, but the lending requirements and stipulations are lighter in most cases. It really won't matter in this particular situation, but it will be a lower interest rate because you still will get an interest rate with what we're about to tell you. Okay. So, okay, I know I need to go to number one, a credit union. Got it. Two, you need to have at least at a minimum $500 in the bank. $500 in the bank.
We'll work at $500 in their personal bank or $500 with the credit union they're going to go to.
In the credit union that you're going to do the next few steps with.
Okay.
So you should have $500 in the institution that we're about to give you the strategy for. So what is the strategy? The strategy is this. Call your bank, go into your credit union, and say, I would like to take out a secured loan. A secured loan means they're giving you a loan based off of the security that you have that same amount in your account in case you default. In a lot of cases, the vast majority of cases, you're going to get approved for that loan with very little scrutiny. In some cases, they even do what's called a soft credit check, meaning it's not a hard credit check. It may not hit your credit the same way as a traditional loan will, which I think every 3 inquiries on your against your credit will hurt your score. So every 3 times you apply, there's an inquiry, a hard inquiry.
Real quick, are you saying 3 hard inquiries or 3 soft inquiries will hit your credit?
Great question, Leon. I'm talking about 3 hard inquiries. And so sometimes with secured loans, because they're secured, they already know the money's there. They'll do what's called a soft inquiry, which doesn't have the same effect on your credit score. So now let's move on. So you know you need to go to a credit union. You know you need at least $500 in that credit union. Now what do? You make a phone call or go into your branch and say, I would like to do a secured loan. They're going to say, how much would you like the loan to be? You put $500 in that institution already. So you can say $500. Now they're going to go look, tick, 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 tick. They're going to go check their computers. And they're going to say, okay, this person has $500 in. We'll give you a loan for $500. A secured loan also comes with a very low interest rate. I mean, it might be anywhere from like 2 to 5% just for people with bad credit. And that is a beautiful thing because, of course, we don't want to have a very big interest rate. So, we don't want to pay a lot of money to have the opportunity to build our credit. We want to do this as economically as possible. So they tap their computer, they realize that you have $500 in that institution's account, and they're like, okay, we'll approve it. Where would you like us to send the money? Then this is where it gets fun, exciting, and all the things. You say, I would like for you to send the money to my savings account with your own bank. Okay, no problem. We're going to give you a loan from our bank, our credit union, and then we're going to put that credit union loan that you just got approved for into your credit union savings account. Yes, you are. Okay, we can do that. Where would you like us to take the money from? The same account you just deposited it into. So now they're like, okay, we'll deposit this in. We'll take the payments out from this account. So everybody, I'm going to do a little pause. So I'm doing it on purpose. Whose money are they paying back the loan with? Yes, you got it correct. Their own money. So they're going to be paying back the loan they approved to you with their own money that they put into your account. This is super exciting. I get excited even talking about it. So now they're going to take the money they put into your account and pay themselves back. But remember, there's an interest rate involved. You're going to get some type of interest rate. So what you do is once you get approved, the person to whom you're speaking to, Mr., Mrs., whomever, can you please tell me what the total interest is going to be on this loan over the course of my payback period? And they may say anywhere from like $7 to $15, $17, $18. That means that's how much you're going to have to pay for that loan. So whatever the amount is that they say, make sure you take out of your pocket. I think what make sure you deposit 500 plus that amount, whatever the amount is. The last time I did this personally, I want to say the amount that I was charging interest was $4.22.
How much was your loan for?
$500.
Oh no, okay.
Yeah, I never do more than that.
Yeah.
So there's no point, because what you want to show in your credit report is a loan being approved and a loan being paid off, a loan being approved and a loan being paid off. That's what you want to show, because it tells the rest of the credit world that you are credit worthy. You will pay back loans. It doesn't necessarily show that it's a secured loan. It just shows loan. So now your credit score is starting to tick up. And each time you do this, your credit score can go up anywhere from, it really depends on how, your personal credit situation, but it can go up anywhere from 7 to 30 points, depending on who you are each time you do this.
And so we're good for you personally. What did you see for your credit? How much did it increase? Again, everyone's credit score is different.
Yeah.
But for you, what did you see?
So I have a pretty good credit score. And because my credit score was already pretty high, I saw a move of about I think it was 9 or 11 points.
Right.
Each time I did it, which was still, great.
And
perfect credit is 850.
Right.
Just for those of you all who are wondering.
So okay, so how many times a year should this be done? And is there like a limit to like this will start to get, what's the term?
Flagged or
yes, it's something that's gonna be like flagged as this person. Now again, to the bank, I would imagine they don't even care, because they're saying, look, you're paying back our money. That's all we care about. Plus, we're getting that little bit of interest. All we care about. But let's say people are like, okay, great idea. I'm gonna do it. But I'm gonna do it like every month. I mean, I don't know, or maybe this is realistic. Every 3 to 6 months they're gonna do it. Yeah. Could a red flag be raised or not?
It really depends on the institution. But from the credit bureau standpoint, there's no flag to raise besides the fact that you have good credit. It's almost the equivalent to saying, if we keep using our credit card, will we get flagged? Like, no, you won't. And truthfully, every time you use your credit card, it's kind of a bit of a loan.
And I was gonna say an example of why it probably wouldn't be flagged is if you can literally go out and get. I mean, of course, your credit could be dinged because there may be credit checks. But if you go out and get 5 secure credit cards, if 5 banks give it to you, there's not a problem with that. So again, it's secured, so the bank is covered. They don't really care. And like you said, for the credit bureau, they don't really care either, because they're just saying, hey, this person's paying back the loan. So yeah, I from what you're saying and what we know about kind of loans in general, as long as you pay back the loan, I don't think the bank will really care, because again, their whole thing is they want that interest from you.
Also, it shows that you're an active credit user. So there's one thing to be an active credit user, and there's another thing to use too much credit. Too much credit means that, again, it's putting pressure on your debt to income ratio. When it's a secure loan and you're not getting approved for $20,000, $100,000 in credit, you're getting approved for $500. So it's not hitting your debt to income ratio the same way, and then it's being paid off. So it's not the same pressure as it would be if it were you being approved for just a open-ended credit card, meaning that credit card may give you approval for 20, 40, 50, 70, 100, $300,000, but you only need to buy, $2,000 in art supplies. So now you just have all this outstanding potential debt, just sitting there. And that's when your debt to income ratio really gets off, because you can, at any point in time, you can also have too much credit outstanding. If you have too much credit, just you've been approved to so many cards over the course of time, if you transact the business on all those cards at one time, you don't have enough money to pay it. That's too much credit. So if you have too much credit out there, the credit card companies do not like that as well. And that's why we're saying $500. $500 kind of flies under the radar. Nobody's checking for it. And it's reasonable for an everyday person to need to get their hands on $500 very quickly. So you have all the strategies, you have all the tools. You can go out there, start building your credit right now. Hopefully this also educated you on credit, because some people, right, with the current economy, are living on credit, like legitimately living on credit. So if you can use any of these strategies to make this time period, hopefully this short time period in history, more comfortable, that's what we want to do. We want to give you a strategy to make it more comfortable for you. Now, also for you all who, maybe you don't have any credit at all, this is a great way to get started building credit because it's secured. So you're not going out and for the first time making the mistake that some students or some young people make when they get their first credit card and it's a $10,000 limit and they think, oh, free money. I'm going to charge all 10,000 because they have access to it. In this scenario, even if you went out and you went crazy and used the whole 500, you already put 500 in anyway. So you backed yourself up, even though you shouldn't.
Right.
You should not touch. Like, this loan is designed for you never to use, never to touch, never to have access to use it for anything outside of building credit.
The purpose of the loan is to pay back the loan.
Yes, that's
Free.
it. Not to go do something in the meantime. Not to get a quick, vacation. No.
This money pays back. And like I said, the only money you're putting into this loan is the cost of the interest. So if the interest is, let's just say $10 on that $500 loan, you deposit. They're going to deposit the 500 into your savings account at the credit union. You deposit the $10 for interest, and you leave it alone. And every month they'll just draw that money out and build your credit over time. So Brent, question: how many times? So I think we talk about your score before on here? Brent has a immaculate score. I should say that immaculate. Mine is not immaculate. Brent's is.
Well, either way, the big thing is,
So here's my question. So Brent with his immaculate score,
yes.
just above 800. Let's just say that. How many times have you, someone who has an immaculate score, and have used this to build your credit? How many times you say over the years you've done this?
I probably have done the strategy about 6 times.
Okay.
And so, I mean, everybody has to. I mean, if we were putting it out there. At one point in time, my credit score was like a 620, and so 620 is like the low end of fair, and I knew it. So I was really trying to figure out strategies to get to where I am today, and this is one of the strategies that helped me. So I did it. I've probably done it more than 6 times, but at least 6 times. And the credit union never called and said, "Why are you doing it?" The credit union never said, "Hey, wait, you did this before." It was, as long as I was paying it off, everybody was happy. So just make sure you're disciplined not to touch them. I never touched it. I never said, "Oh, well, let me go fill up the gas tank real fast," or "Let me get some groceries," and I put it right back. That account did not exist to me, and you need to make sure it doesn't exist to you. And the other part too is the term. We talked about everything about the loan, but we didn't talk about how long is the term. You want to make the term as short as possible. But not like 2 months. So don't get it and just pay it off. Like, don't do that, because you need to establish history of payment. So to establish history of payment, you want it to be at least really 4 months of paying it back before you just either pay it off, or when you first set it up, you're like, "Oh, I'm gonna pay it back in 2 months." Like, don't do that, because it doesn't establish payment history. So you want to have it for at least a term of 4 months or more. Really, I would say 5 months or more.
And with that, so because they're going to give, I would imagine they're going to give you the terms of.
Well, they're going to ask you when you do the loan.
Okay, so you can set the duration of the loan.
Yeah.
And what about the amount paid back, the monthly?
I mean, you're paying about $100 a month back at 5 months.
Oh, based on that. Okay.
Yeah.
Okay.
At 6 months, you're paying roughly like $87 a month.
Right. Okay.
So it's you already know it's going to be fast. It's going to go very quickly, and that's what you want. I mean, 6 months, I think, is the maximum amount of time you want to have it. The minimum is, I would say, do it for at least 4. So that's everything that you would need to make this a very successful credit raising activity for you. You can start doing it with your children. If you have kids and like, "Oh, this is a good way to start, educating my kids on how to, use loaned money, or what a loan even is." Please show them this recording and listen to our podcast. So Investing Education Academy has like great information like this all the time. And if you go to www.investingeducationacademypodcast.com, no, IEApodcast.com. Again, that's IEApodcast.com. You will get information like this from years of us doing this podcast. and it's designed to be useful. Actually, before we even jumped on today, Leon was like, I don't want to do a podcast unless it's something people can make it actionable. It has to be actionable. So this is actionable. You can do it tomorrow. You can, whenever you're listening to this, call the next day and get it done.
And I just want to say about this. So, I mean, we've all seen like the quote unquote fix your credit crap, really, the last like 10 years. Like the whole like fix your credit thing actually became like an industry in and of itself. And 99% of it turned out to be scams, right? It was people that said they would act on your behalf, talk to your creditors. Now, I'm not saying all are scams. Some, of course, are legit. But what we're saying is we're not doing anything. Like we're just saying we're not trying to manage you. We're not trying to talk to creditors. All we're saying is this is a way for you, the individual, to increase your credit score yourself. And the way we're doing it, it's not talking to creditors. It's not trying to negotiate. We're just saying follow what builds credit, which is taking out a loan and paying it back. Period. I mean, a lot of people think that loans can only be done if you're taking out a loan to buy something, car, house, whatever. We all know personal loans exist, but as Brent brought this to all of us now, and even me, like a year or two ago, you can take a personal loan out and not use it, and literally use that money to pay it back, which I thought was damn near genius. Because I never thought about it. But it's a tangible way to use the system, the way in which it was built to build credit and not have to rely on other people. So yeah, look for a credit union one that you trust, one that you work with now, or do some research on finding one, and go take out a very small, very manageable personal loan, $500, as Brent said, and then just pay it back over time.
Yep, secure loan. Don't forget, secured loan.
Secured loan, yes.
When you call in and they say, well, what type of loan you're looking for? A secured personal loan. So that's everything for us today. We owe you all 2 stock picks, which we will deliver inside of our platform. So if you're not a member, you can go to IEAmembers.com and become a member. You can also find us, if you're looking for the podcast, go to IEApodcast.com. And you can find this information and some of the wonderful information Leon and I have been putting out for the last 3 years or so. Actually, I think it's 5 years.
5 years, yeah. Started during COVID, so
wow.
2020.
Okay. We need to do something for our 5th. All right, everybody. We thank you for